Greetings. This is going to be our monthly inflation update for February of 2023. And inflation continues to be in the news, whether warranted or not, because inflation sells. The media makes a lot of money by making you angry or frightened, and inflation is a very good way to make people angry or frightened because when you go to the store, you see that a few prices are higher relative to what they might have been a few years ago, but people don't consider their salary gains to be anything associated with inflation, or if they own a home, their home equity gains. Somehow their home equity gains are because of their own intelligence and not a function of the ambient inflation. That is why deflation would be very bad for society. Yet the United States is reaching a point where a lot of people think deflation will be good because the media told them inflation would be bad, therefore they think deflation would be good. And this is going to test democracy because if voters vote for deflation, then the system is going to collapse. So this is going to be a frontier test of democracy. But now on to our scorecard. As longtime viewers are familiar with, I say that inflation is not higher than optimal until all three of these metrics are above 3% a year. And the optimal inflation rate would be for all three of these to be at 3%. Too far below 3% is also insufficient inflation, which causes economic sluggishness, the risk of deflation, debt defaults, and things like that. And these three metrics are the U.S. Consumer Price Index, 10-year compounded annual growth rate to smooth out the short-term noise. Then the most important metric of all by far and rising in importance, the Goldman Sachs Commodity Index. This is unriggable because it is a composite of commodities that are A, priced worldwide, and B, traded freely every day. So all these things you hear about how the US CPI is deliberately measured incorrectly to suppress the real inflation rate, that is completely bogus because the Goldman Sachs Commodity Index is unriggable. It is unriggable and it's worldwide. And then the third measurement is the 10-year US Treasury Yield. This is more an expectation of future inflation rather than a measurement of past inflation, but it is unrelated to these other two, so when you combine all three of these, you have a comprehensive multi-dimensional measurement of what inflation is. And all three of these have to be above 3%. If one is above 3%, but another is well below 3%, that is still not high inflation. It's not even optimal inflation. The optimal would be if all three were exactly aligned at 3%. And that is a certain elegant symmetry to it. But unless and until all three are above 3%, I'm not going to say inflation is too high and that money printing needs to be dialed back. The reversals in money printing that some central banks do tend to always backfire and they end up having to print more money for the reasons I explained many times on this channel. Technological deflation is exponential. So let's go to the Goldman Sachs Commodity Index first. Goldman Sachs Commodity Index from Standard & Poor's, the 10-year compound annual growth rate is minus 1.85%. That is a long way from plus 3%, minus 1.85%. Oil is in deflation. Gold has failed to rise for 12 years. Oil crossed $100 a barrel in 2007 and 2008, and now it is only $66 a barrel. There is no commodity that has risen substantially in price relative to 10 years ago or even 15 years ago. Goldman Sachs Commodity Index is in deflation. I believe we're at a point where the technonomic medium of the world is now so powerful and so advanced that commodity prices can never catch up to a 3% a year inflation trend line. I'll do a video about that at some point as well. But minus 1.85%, far, far from plus 3%. Now we go to the 10-year U.S. Treasury Yield. The 10-year U.S. Treasury Yield is 3.395%. So this is above 3%, but it's come down a fair amount. It was actually touching 4%. It's come down to 3.395%, so slightly above 3%, but it cannot stay high for very long because that then correlates with a housing bust and a real estate crash in the United States. So 3.395%. Lastly, we go to the U.S. CPI. The BLS.gov website will be in the description box below, but this is the US CPI, and the 10-year compound annual growth rate is calculated by taking this number, 302, divided by the number exactly 10 years ago, which is 232, and then the 10th root of that. I've demonstrated the mathematics of how to do this in prior monthly editions of this video, but the 10th root of that, and I will show you what that is. That comes out to about 2.7%, below 3%, but the 10th root gives you the annual compound growth rate. And as you can see, this 1 month percentage change has already moderated down. Same for the 2-month percentage change, 3-month percentage change, 6-month percentage change, And this 1-year percentage change is already drifting down. It's not plunging like a rock, but it's drifting down at about the same rate that it rose up. Now let us go to that table that I introduced a few months ago so that you can see what the annualized numbers are for all these different time windows. Plugging all of those readings into this table gives us the annualized CPI growth rate on a 1-month window, 2-month window, 3-month window, and 6-month window. And you can see all of these are in the 4s and 5s range, which is above 3%, but still quite a bit below the level at which they were screaming about in the media a short while ago. The 1-year CPI is 6%, but dropping as we saw. And then if you take the longer term windows, over 2 years, 6.8%, because the bulk of the high inflation months, which were in early 2021, were in the 2-year window, but not the 1-year window. Over 3 years, 5.4%. Over 5 years, 3.9%, and over 10 years, 2.7%, and this is the number that we look at, 2.7%, to smooth out the spikes. But since these numbers are lower than these numbers, the big bulge is certainly behind us, and no, inflation is not at a crisis level, even though this should get down to 3% before too long, so that this stays below 3%. I hope everyone understands the mathematics of how this works. Now we go back to my scorecard. So we looked at all three: the US CPI 10-year compound annual growth rate, the Goldman Sachs Commodity Index 10-year compound annual growth rate, by far the most important of the three, and the 10-year US Treasury Yield, and we come up with 2.7%, as we saw, for the US CPI, that is below 3%, minus 1.85% for the Goldman Sachs Commodity Index. That is so low, that is far below the 3% threshold. I don't think any amount of money printing can make this above 3%, because the economic medium of the world, the software proliferation through the economy, makes the economy far less vulnerable to inflation, as I always speak about. That is the crux of the atom thesis, and that is why we have commodities in perpetual deflation. Commodity prices are the most important because that indisputably represents a cost to all types of consumers and businesses. Whereas services inflation, it's more ambiguous there. One can say that the price of a haircut has doubled over the last 3 years, but then the hairdresser is making twice as much money for the same amount of work if there's the same amount of haircuts over there. So his wages rose tremendously. So the customer's paying more, but the barber, the hairdresser, is making much more. So it's more ambiguous about where service price inflation should optimally be. It's not indisputable that low is good and high is bad in all cases, whereas with commodities, lower the better no matter what is an easy rule to go by. And the only one that's above 3% is the 10-year US Treasury Yield. It's 3.395%, so above 3%. If this stays high for too long, then it exerts tremendous pressure on the US housing market, causing a housing bust, but that also leads to more deflation and therefore much more money printing as well. So this was our monthly inflation update, and as you can see, for all the screaming and scare tactics about high inflation, nothing of the sort is going on at all. Not everything is perfect, but it's far, far, far from a threshold where you should actually worry about inflation. It's become ridiculous. People have truly lost their minds on the subject of inflation, as I have spoken about in other videos. Now, if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.